Hey, good afternoon, everybody, and Happy New Year. Today is Friday, January 29th, and this is our forecast for 2016. In a word, this past year, as well as this upcoming year, has a lot to do with perspective. Today, we're going to spend a little bit of time talking about 2015, where we are today, and also what the year 2016 may look like. But before we jump into the educational part of the presentation, I thought we'd get everybody's brain kind of warmed up and start thinking a bit about perspective. If we take a look at these two symbols, which center circle looks larger to you? When I first looked at this, I thought for certain it was the one on the right. The reality is they're both exactly the same. This is called the Ebbinghaus illusion, and it demonstrates the importance of context. Sometimes an event or a comment can be made to seem more important or less important depending on the context. Let's take a look at this chalk drawing. From this angle, it looks, well, kind of disjointed, not exactly put together. But as we walk from left to right, we get a much better view. And it either looks appealing or alarming to some. And sometimes it's the way in which something's presented to you that can make a difference. In this picture, some gentleman is leaning against a tree, or is he really laying down? Today, we're going to look at the economic and financial markets from a variety of different perspectives. Last year, in a word, certainly wasn't robust. The S&P was down about 0.7. Thanks to a fairly robust dividend yield. Ex-dividend, the S&P was down better than 2.5. Bonds, while they yielded 2.2%, were actually down a bit more than 1.8. World index was down almost 3. The international emerging markets were down almost 17. Gold was down over 11. And commodities were down nearly 25, thanks to a huge drop in oil. As such, a multi-asset, globally diversified portfolio, one that diversifies risk by using a number of different asset categories, was probably down in the 4 to 5% range. It was also a pretty volatile year for U.S. markets. You can see this chart in the center of the page, a fairly large and abrupt drop sometime in August. We'll talk a little bit about what factors contributed to that, but we saw quite a bit of volatility last year. In fact, last year was the first year in 4 where the S&P had a hiccup or a pullback of 10% or more. That drop in August represented a 12% drop in assets. I guess all how you look at it, if you looked at the S&P over the course of the year, for the first 8 or 9 months, we had very little volatility. In fact, we've had very little volatility for a better part of 4.5 years. The volatility we're seeing today is actually a bit more normal than what we've seen in the past. And the S&P wasn't nearly as volatile as its subsectors. This is kind of an interesting chart. The horizontal line represents a 0% return. Any of the colored graphs above the line would represent a positive year-end return, and anything below would represent a negative year-end return. The S&P, while it did very little last year, would have done much, much worse if it wasn't for the FANGs, if it wasn't for Facebook, Amazon, Google, or Netflix. And as a result, the returns of the broad-based market were actually much weaker than the return of the S&P 500. The uncertainty about fiscal and monetary policy played a huge role in the stock and bond markets during the year. One of the big challenges that we had last year was Washington, D.C. There was a lot of issues. In particular, the Federal Reserve lost a lot of credibility when they didn't raise rates earlier in the year. And then in November, we had the passing of the Bipartisan Budget Act of 2015. That was the act that was passed at the last minute so that we wouldn't default on our bonds, and they basically kicked the can down the road till after the election this year. So they funded what they needed to get us to that point. One of the major implications of this BBA was some changes that they made to Social Security. Now, there's a lot written about some of these changes, but they really only impact those of you who have not taken Social Security and who are of an age which would be beyond full retirement age. And in Social Security land, that's age 66. So if you haven't taken Social Security and you're above age 66, we probably should talk. Give my office a call because there are some things you might want to consider doing before April 30th of this year. We talked a bit about the U.S. markets. Europe was every bit as volatile as well. The red line represented the S&P 500, as you can see, slightly down on the year. Europe did a little bit better, but Europe certainly also had much, much more volatility. The blue line represents the stocks index, STOXX, which is the biggest 50 stocks in Europe. And one of the craziest things that happened last year was interest rates in Europe actually fell below zero. Now, this is somewhat unheard of. When I studied economics over 30 years ago, zero is as low as an interest rate could go. They are now negative. And that's as a result of a huge amount of stimulus that the European markets, the ECB, is doing. So banks are now paying the ECB to hold their reserves. And banks are paying folks to borrow money. If you actually have a mortgage, the payment you make is principal minus interest. The result of this, or the rationale, is it will ultimately force banks to lend more money. And what they're hoping to do is drive down borrowing costs, encourage banks to lend more. As a result, this should help push inflation higher and stabilize the currency. So far, bank lending is up modestly, inflation remains very low, and there are mixed results for most currencies. As volatile as the US and Europe may have seemed, they are nothing compared to the volatility we saw in emerging markets. Emerging markets last year were extremely volatile, and you can see that in the goldenrod colored graph at the bottom of the page as it compares to both the red and the blue. So why were emerging markets so volatile, and why was their performance so bad? It's a result of really three things. Trade growth has really slowed down. Gross domestic product, or GDP, in many of the emerging markets were well above 7% in 2010. In 2015, they were about 4%. Commodity prices have collapsed, and as a result, those low commodity prices have really hurt emerging markets because many of them are net energy exporters. They actually receive quite a bit of their revenue by selling commodities to somebody else. And thirdly, the financial conditions have become a bit difficult. They're facing a rising interest rate environment because the U.S. has changed its monetary policy. And these circumstances will certainly hurt emerging market investors. The Financial Times reported in the Institute of International Finance to expect investment in emerging markets to fall to a little over $500 billion in 2015. That investment level is actually below the level that was achieved in either 2008 or 2009. So the amount of outflow is really pretty significant. And this money is leaving emerging markets and going elsewhere. As bad as emerging markets seem, they really don't seem quite so bad or quite so volatile when we add China into the mix. You may recall experts earlier last year warning that the Chinese markets may be a bit too high and a bit overheated. In fact, The Economist wrote, "Examples of excess abound. A pet food company trades at 221 times earnings. a sauna maker at 285 times, and a manufacturer of fans at 732 times earnings. Chinese companies have long had a tenuous relationship with economic reality, but the current rally has gone to new extremes. In fact, by June of last year, China, or the Shanghai index, was up over 60% for the year. And then came the big tumble. And that tumble then caused some reverberation in our markets. Yet, after being up nearly 60%, the Chinese markets fell significantly, but finished the year up a little over 9.4%, outperforming both the US as well as Europe. Another issue with respect to China is things aren't always what they seem. Strong market performance may be somewhat tempting to invest in China despite the extreme amount of volatility. But not all Chinese companies are in great shape, according to The Economist. In fact, The Economist said there was a time when China's biggest state-owned enterprises were seen as country's crown jewels. In fact, the Chinese big stake firms were largely a bloated, inefficient lot. The real dynamism in the Chinese economy has long come from its entrepreneurial private firms, which now, by the way, account for 2/3 of the country's entire economic output. In addition, China doesn't have the same regulatory controls that are in place here in the US or other developed markets, and as a consequence, it can be a bit difficult to evaluate the health and prospects of Chinese companies. Just came back from a 2-day economic summit, and most of the strategists for some of the biggest firms on the street are now somewhat throwing in the towel with respect to China, and they're really looking beyond China at India. And when the emerging markets return, India is kind of the place that a lot of folks are really beginning to look at. Another interesting thing about China this past year is the IMF decided to add the Chinese renminbi to the reserve currency basket, and that'll start October of 2016. To meet the IMF requirements, China is going to be forced to give up some of its tight control over its currency, and as a result, this culminated in an abrupt devaluation of the renminbi, which took place in August. These changes will inject additional degrees of volatility, and in fact may even be the beginning of some kind of a price war or currency war. We'll see how that affects us this coming year. There was no doubt that 2015 was an interesting year. So where are we now? Well, this is an election year, but it'll be an election year without the Colbert Report. So we won't have his pithy comments and observations to deal with. A lot of people look at this presidential cycle, and you hear a lot of folks talking about, well, it's a presidential year, things should look much better. It's really kind of a push. It depends on where the valuations are at the point that you enter into the presidential cycle. And when you look at the 4 presidential cycle years in the chart, first, second, third, fourth, you'll see a vertical line, a thin line that measures the degree of volatility, the range in one year, best versus worse. And you'll see how in years 1 and 2, the range is pretty substantial, up 30% to down nearly 10. The blue box represents the average highs and lows. When you move into year 3 and year 4, thankfully, the range looks a bit better, where the lows are either 0 or maybe a -5, and the blue box is situated where there's much more upside than downside. Hence, the presidential year cycle lore. So this could be a good year as a result of it being an election year. It might have a lot more to do with other factors. You know, the other maybe wives' tale is Republicans tend to be better for markets. The reality is it depends a whole lot on when you analyze, what period of time, what measurement do you look at. Are we looking at stock market performance or economic growth, etc.? For example, if we looked at a huge period, 1928 to 1980, 1980, the average gains in the market during a Democrat in the White House was about 12% versus a Republican in the White House of about 2.6. Conversely, if you looked at a different period, 1952 to 1992, the Republicans had a slight edge. One of the problems with this is business cycles or periods of expansion and contraction and recession don't fit neatly into presidential terms. The consequence of one president's action is usually realized during the term of another president. So some of the problems we have today, the next guy will inherit. The stimulus that the Bush administration put in place, Obama's team inherited and carried out and gets credit for the upside as a result. Now let's expand our view beyond the U.S. elections and explore relative strength of various world economies. This is kind of an interesting chart, and you can see these are projections for this upcoming year: U.S., Europe, UK, Germany, Italy, Japan, and then we come to Russia and Brazil. And clearly the first couple of quarters of this year are going to be really, really challenging for both Russia and Brazil. The big reason has a lot to do with oil. Oil prices have fallen about 60% since the summer of 2014. In part, price disruption was caused by the falling demand in China as well as Europe. It was also caused by a glut of supply as U.S. production ramped up and OPEC maintained a level of output that was driven, that effectively drove prices a whole lot lower. Economically, it's great for consumers. So as a result, countries that tend to be net importers of oil, Europe, should see net improvement. In early December of 2015, just a month or so ago, the U.S. Energy Information Administration reported that a barrel of Brent was selling at about $40 a barrel. A week or so ago, it was near 26, and as of today, it's probably a whole lot closer to 33. That seems pretty low when you consider that the price was more than $106 a barrel in July of 2014. But is it all that strange that prices have dropped as much? Let's give the price of oil a little bit of context here. Who remembers when oil cost less than $1 a gallon? You know, that was back when Jimi Hendrix first performed the Star-Spangled Banner at Woodstock. I was a small boy at the time. It was also the year that the New York Mets won the World Series, and a Super Bowl ad cost about $55,000. The year was 1969. And oil was about $3 a barrel. Does anybody remember which year gas rose above $1 and then never went below that price again? For those who said 1981, you're right, but oil was $1. It stayed at that level until about 1986, and then it dropped actually back down again. The price didn't hit $1 and stay there until the year Milli Vanilli won the Grammy as the Best New Artist. That award was later rescinded. It was also the year Buster Douglas knocked out the then world champion Mike Tyson, and a Super Bowl ad cost about $700,000. That year was 1990, and oil was about $15 a barrel. So as you can see, oil has been priced a lot lower than it's been So as you can see, oil's been priced a lot lower than it has today. In fact, oil has even experienced this kind of volatility before. Does anybody remember a year when oil prices fluctuated this dramatically? It was the same year Christina Aguilera won a Grammy for singing Candyman. Michael Phelps won 8 gold medals in the Summer Olympics, and a price of a Super Bowl ad was now $2.7 million. It was just a few years back, 2008. At that point, oil was $144 a barrel by June and finished at $36 a barrel by the end of that same year. So as you can see, oil prices have certainly been higher and lower and just as volatile. According to The Economist, oil prices are responding to supply and demand, not OPEC. And that means that the market is behaving in a normal way. And this normal way is somewhat unusual. Falling prices are increasing consumption to a degree. However, the amount of oil consumed per unit of economic output is declining. We're becoming a bit more efficient. Growth in emerging markets, especially China, is less energy intensive. A Paris-based forecaster representing the oil-consuming nations predicts a relatively slow recovery in demand and decline in supply could lead to a price of about $80 a barrel in 2020. As such, we don't know where oil will be this year or next month or next quarter, maybe higher, maybe lower, but certainly energy as it relates to our portfolios certainly will at some point have a home, as we do think the long-term prospects are better than $30-ish a barrel. Oil prices are getting a lot of attention right now, but so are the central banks. The concern is central banks are pursuing divergent policies. Here, the Fed raised interest rates for the first time in almost 10 years, which has a lot of folks speculating about interest rates in the American economy. Meanwhile, the ECB is pursuing unconventional monetary policy, including quantitative easing, effectively doing the exact same thing Ben Bernanke did 6 or 7 years ago in an effort to reinvigorate their economy. China is also pursuing easy money, as is Japan. So in many parts of the world, central banks are keeping the foot on the gas pedal, even though here in the U.S. we've raised it off the gas pedal a bit without really hitting the brakes. Experts suggest that short-term implications of this kind of divergence of policy are fairly predictable, but in the long run it's a lot harder to ascertain. So what that means really is in the short term it favors a stronger dollar relative to international currencies, which could have an impact, somewhat negative impact, on U.S. manufacturing. Monetary and fiscal policies put in place by central banks and governments, may have contributed to a strange degree of behavior in these markets over the last several months. That's at least what Ben Inker at GMO Management suggested. He wrote about a month ago that market behavior is linked to price insensitive buyers, such as monetary authorities, central banks, pensions, insurance companies, folks that are in the market and they're buying indices without any real concern over price. They're in buying because they have to buy, and as a result, they tend to drive up prices. So, is the U.S. stock market high, as some people say? Well, as I said, I just got back from an economic summit, and there are just as many people that can make an argument for an overvalued market as those who can make an argument that there's plenty of room left. One such person who's somewhat positive is Stephen Oth, who's the CIO of Federated Investments. Stephen said, with long-term bond yields stuck below 3, the likelihood to remain there for some time, we see investors as gradually coming to the realization that equities, with their growing cash flow streams on the back of solid business prospects, are worth far more than current levels. Indeed, we expect that before this bull market is over, we will see forward-looking PE multiples on equities move into the low to mid-20s. That would suggest as much as a 20% improvement over time. There are also others who say, yes, things are overvalued. Henry Blodgett, who back in the 90s, pre-dot-com, was one of the biggest bulls on the street, touting many of those same dot-com technology companies that are no longer in existence today. Henry said, according to several historic valid measures, stocks are now more expensive than they've been any time in the past 130 years. Henry's research is kind of based on the Shiller CAPE valuation index. Professor Shiller, Nobel Prize winning economist, created about 20 years ago the CAPE 10 index. Everybody's familiar with PEs. The Cape 10 is cycle adjusted PE, and they use a rolling or averaging 10-year PE. And he indicates that valuations are high. At the end of 2015, the PE was on the Cape 10 index was 26, which is well above the long-term average of 15. Now, before everybody runs out and gets concerned about where valuations are, there's an awful lot of controversy over the Cape PE. Mr. Schiller teaches at and is a chaired professor at Yale. I had the privilege of sitting down and listening to an esteemed economist, chaired professor at the Wharton School just Tuesday, and he presented a paper which effectively described the systemic problems with respect to the Cape Index. The first is the Cape average goes back to I think it's 1860. That was before the SEC. That was before the Investment Act of 1940. It was before the Federal Reserve. Markets are less risky today as a result of that, and as a result can command a higher PE. Additionally, there were a number of FASB accounting standard changes which also made things more predictable, less risky, and as a result able to sustain a higher Cape index. Others say, hey, we need to own equities for the long term. It really doesn't matter what current price is as long as we're not looking at a trade. So where may we be going? We took a little bit of a look at where things were in the past, last year, where things are presently. What does the future hold in store? Well, actually, the projections for GDP are really not that bad, with the exception of the U.S., and I think a lot of this is as a result of the strong U.S. dollar. Just about every other region, Europe, China, Japan, Latin America, are expecting a slight improvement, a slight increase in GDP for 2016 as opposed to 2015. Even in the U.S., we're hovering at about 2.5%. And with our growth rates and long-term prospects, 2.5% is about what we're going to see. We're not post-industrial revolution, the days of sustained 3 and 4% GDP growth rates are probably a bit behind us. China, which is expecting a slowdown from 10% of several years ago to 7%, most nations are really saying, well, that's really to a large degree more like 3 or 4. In any case, we expect stable GDP last year to this year. If somebody is concerned about something, it's what contagion might there be with respect to the slowdown in emerging markets as a result of the weakness in commodities. As you can see here, this chart showing world growth. Blue represents developed countries' contribution to world economic growth. Red is emerging markets, and obviously emerging markets have much more of an impact today than they did 20 or 30 years ago. One issue that we're watching very closely is the impact on debt in emerging markets. They have found debt and they're using it significantly. Debt levels have increased throughout most of the emerging markets, Brazil, Russia, India, and to a lesser degree India, and more so China. Debt in emerging markets have increased 150% from 2009 to 195% in 2015. That's of GDP. 3/4 of the private debt in emerging markets is held by businesses, and corporate debt has grown from less than 50% of GDP to almost 75%. Rapid credit growth has signaled trouble in emerging markets before. However, according to the Wall Street Journal, economists think many countries have learned from the past and have built currency reserves and established flexible exchange rates to guard against said downturns. The Wall Street Journal also reported, in a worst-case scenario, the IMF estimates that broad turmoil, sell-offs in equity, financial assets, sell-off in bonds, spike in borrowing cost, could slash around 2.5 percentage points off of global GDP growth in the rich countries through 2017. So if everything hit the fan, we'd be looking at a stagnant growth rate, probably not a recession. And that's one of the reasons that a lot of people have kind of weighted the probability of entering into a recession here at very, very low. The Federal Reserve has obviously here begun to tighten monetary policy. As rates increase, borrowing costs around the world will also increase eventually. Higher interest rates, low commodity prices, higher debt levels, and the rising dollar could create issues among some of these emerging countries. Higher rates may create issues for developing countries as well, although a lot of developing countries have even more checks and balances in place today. There is still uncertainty about how the Fed's changing policy will affect global economies and markets. No matter what the answers are, divergent central bank policies are likely to produce market abnormalities, which may create investment opportunity. As I said, international markets may in fact be the benefactors of an increase in stimulus, a continued drop in interest rates, and for the first time in several years, we may see the lead change where international securities provide better performance than securities here in the States. Terrorism could also hurt economic growth. After the terrorist attack occurred in 2015, it's impossible to ignore the cost of terrorism. Lives are lost, injuries are inflicted mentally and physically, property is damaged. The World Economic Forum reported that economic impact of terrorism was about $53 billion in 2014, the highest since 2001. Terrorism also affects military spending, consumer spending, and financial markets. From 2003 to 2006, world trade grew faster than world GDP. The long-term average for growth of world trade was about 5%. During the first half of 2015, year over year, trade grew at only 1.7%. Part of the problem can be cyclical, but economies will suffer until countries take steps to improve trade growth. Now, let's look at expectations for financial markets during 2016. So where are the markets heading for this year? Will the third longest bull market on record continue, or are we headed into a bearish territory? When Barron's asked 10 market strategists what they thought would happen this year, they all agreed markets will move higher in 2016. Strategist expectations are good news for the bulls. There was good news as well for contrarians. Most people like to follow the crowd. In his 1985 chairman's letter, Warren Buffett shared a story that Ben Graham used to tell to demonstrate that. For those who don't know, Warren learned finance from Ben Graham at Columbia. Ben was the father of modern financial analysis, and Ben used to tell his class this story. An oil prospector, moving to his heavenly reward, was met by St. Peter with bad news. "You're qualified for residence," said St. Peter, "but as you can see, the compound reserved for oilmen is packed. There's no way to squeeze you in." After thinking a moment, the prospector asked if he might say just 4 words to the present occupants. That seemed harmless to St. Peter, so the prospector cupped his hands and yelled, "Oil discovered in hell." Immediately the gate to the compound opened, and all the oilmen marched out to head to the nether regions. Impressed, St. Peter invited the prospector to move in and make himself comfortable. The prospector paused. "No," he said, "I think I'll go along with the rest of the boys. there might be some truth to that rumor after all. Contrarians are investors who prefer not to follow the crowd. A contrarian might interpret the barren outlook as a sure sign of a correction coming. Of course, contrarians are like everybody else with one respect: they're not always right. A bond analyst recently stepped forward with a surprising prediction of interest rates in 2016. Steve Major, head of global fixed income research at HSBC, is suggesting that the 10-year Treasury bond may in fact drop to 1.5% in 2016. Now, that's quite a bit less than what the consensus is, which is more like 2.8. There was one gentleman at the conference I attended that also suggested that the Fed has it wrong. They're going to need to cut rates this year, and that will be the big surprise. Conversely, Dan Fuss, vice chairman at Lumen Sales and a legitimate bond guru, thinks the Fed will follow suit with additional interest rates, additional hikes, and the 10-year Treasury will be in the 2.6 to 2.8% range. He is in the majority camp. So while outlooks for economics and markets are interesting, what's really important is your own personal financial goals. It's just as important for us to know how your lives may be changing in the upcoming year than it is for us to be aware of forecasts or predictions. Maybe there's a marriage or a new grandchild on the way. Perhaps a daughter or son-in-law just joined your family. Maybe an illness has cast a shadow on your household. No matter what's happening, life changes play an important role in determining the financial strategy that's right for you. And in closing, look, I can assure you that no matter what 2016 holds, we'll be here to help. Our disciplined investment process was designed to help you reach your financial goals. While we monitor economic and market developments closely, we don't let the noise of day-to-day events determine our actions. We will not take action till our process indicates we should. We have confidence in our process. It is the reason we sleep well at night. If you have any questions about anything that we've covered today, please give us a call. I wish each and every one of you a happy, healthy, and prosperous 2016. And from all of us here to all of you out there, Happy New Year, and thank you for your continued support.